Welcome to the award-winning Moneymakers podcast. I'm Jonathan Davis, the founder and host. For more than 6 years now, we've been providing comment and discussion about all the latest developments in the world of investment trusts, the stock market listed funds often called the City of London's best-kept secret. I'm grateful to JP Morgan Asset Management for their continued no-strings support, which enables us to keep the podcast free while preserving our truly important independent editorial principles. Please note that while our comments are well-researched and our opinions honestly held, we do not offer individual stock recommendations. This week on the Moneymakers Investment Trust podcast, I speak to two guests. Coming up later on, I'll be talking to Alexander Fitzalan Howard, the manager of JP Morgan European Growth and Income, who I last spoke to during the week of Donald Trump's Liberation Day tariff announcement about 15 months ago. But first, I had an opportunity to speak with Mark Niznik, who is the lead manager on the Artemis UK Future Leaders Trust. It's good to have Artemis back in the investment trust sector. It's a specialist boutique equity management firm based in Edinburgh. Has done very well, established a strong reputation over the years. Lost a couple of mandates in the investment trust sector not so long ago, but now has picked up a couple of new ones instead, including this one a couple of years ago. More recently, Artemis also took over the running of Murray Income. So, Mark, you've been involved with Artemis for 20-odd years or so. Tell us why investors should have a look at Artemis. What's the story? What's the reason why Artemis has survived and continues to do well as a boutique fund manager?
I think the culture of the business at Artemis is fantastic. It's certainly the best that I've ever worked in my career. And I think we're a partnership model, and I think that allows us to invest for the long term. So the UK equity team at Artemis is 11 people strong. On average, those colleagues have been with the firm for over 13 years. So that's a great tenure, very experienced colleagues that Will Tamworth, my co-manager on this trust, and I can gel with and get overlapping views from. I'd also say that the model allows us to invest in the team. Only recently, Will and I have added Anna Pugh from River Global as a new small cap equity analyst on the team. So we've been expanding the small cap resource at a time when others are doing the opposite.
Right. And let's just then quickly recap how you came to be managing this trust. It was 1 year ago that you took over the running of this trust, I think, a little over 1 year ago. Is that right?
Yes, we took over the management contract in March 2025 from Invesco Perpetual. So we've been managing the fund for just over a year now.
What was your pitch to pick up the mandate? Is it just the one you've just given me? Essentially that you've got a very strong, dedicated team in smaller companies and UK equities generally. Was that the pitch?
The pitch to the board that we made was one of a continuation of using the investment process that Will and I have been using for the last 11 years, working together, and me for the 20 or 30 years before that. It's a very set investment process, and it's worked through good times and bad. And it's one where we have three aims for the small cap money that we manage. The first aim is to capture the small cap premium, which is the long-term 3% or so outperformance you get from small caps over large caps. So that's what we want to do first. The second thing we want to do is add as much value, outperformance, if you like, alpha, by our stock picking the right stocks. And Will and I have managed to add between 1% and 2% a year after fees in our historic performance. And then the third aim is to do the first two while also minimizing the risk to our investors. And we do that by spreading the macroeconomic risks within the fund by choosing companies from a spread of sectors, and also by the kind of companies that we're choosing. So that was the pitch that we gave. And it was also based on the performance of our larger open-ended unit trust, which at the time we were talking to the board had very strong performance. So it was top quartile over 1, 3, 5 and 10 years.
And am I right that you were actually involved in running this trust before, when it was still an Invesco Perpetual?
Yes, I used to work for Perpetual. And back in, I think it was the year 2000, when Amvascap, who own Invesco, took over Perpetual, I managed the trust then for a year or two. So I'm absolutely excited to be back in the saddle running the same trust as I was running 20 years ago. It's really exciting.
Right, so that's an interesting sort of trivia question. It might come up if they ever do an investment Christmas quiz. Can you find a manager who's back running a trust he's run before? In any case, so here we are. We've been talking about UK small caps almost ad nauseum, it seems, for many years, saying that, it's traditionally been a strong area of performance, not just for firms like your own, but for the investment trust sector overall. But it's been a long struggle, basically, is it not, to actually see those expectations realized. In other words, people have been saying for at least 3 or 4 years that UK equities are unloved and that small caps in particular have been struggling. So what's your perspective on that? What do you attribute that to? And what are the primary factors behind this period of struggle before we come on and talk about what you are doing now and how you're hoping to put that right?
Absolutely. The UK stock market, I would say, has been on the investment naughty step for a decade now. If you look at what's happened in that time, we've had Brexit, we've had the possibility of a Corbyn government, we've had the Kwarteng Trust budget, we've had political changes since then, and more recently we've had the Iranian conflict with the Middle East. So all of those things have combined to be detrimental to investors' view of the UK, and that is especially so of UK small caps because they're much more domestically focused than UK large caps.
Yes, indeed. That said, you took over running the trust in March last year, and obviously your premise was that you could improve the performance. But I think the first 12 months, you probably admit, were a bit of a disappointment. Would that be fair?
Absolutely so. And I would have to apologise to our investors for what it has been a disappointing first year. To explain what's happened, I would put the underperformance relative to the market that we faced into two rough buckets. The first bucket would be consumer discretionary stocks, which have faced a continued nervousness from the consumer. First, there was the delayed budget last year and a lot of negativity surrounding what new taxes might come up in that budget. And then more recently, the Iranian conflict with the US and the inflationary potential from higher oil prices. So that's one area where share prices have been undermined. The second area, I would characterize it in terms of companies felt by investors to be under the threat of artificial intelligence eating their lunch. And here we're talking about software stocks, media subscription stocks. So companies like YouGov, the polling and bespoke research company, GB Group, the global leader in identity verification, or Money Supermarket, those companies have underperformed. But if we step back and actually analyse those companies, although the share prices have been weak, generally in those two buckets, the company's earnings, their profitability, has been in line with expectations. So what's changed is people's worry about the future has increased, not the fundamentals of the business. And there we gain a lot of optimism because investor perception is fickle and can change. It's the fundamentals that are still there. And it's only today, actually, we've had results from one of those companies in that consumer bucket, Halfords, the market leader in garage forecourts. And their shares are up 20% as we speak on slightly better than expected results. And that shows how fickle share prices can be in the short term, which is why Will and I always take a 3 to 5 year view.
Right. So I think it's also fair to say that you've lagged the performance of some other UK smaller cap trusts over that period. And of course, as part of the deal for your winning the mandate, the board has agreed to put in place a continuation vote, which is, I think, coming up. Is that next year?
Yes, it wasn't part of our pitch, but the board has a continuation vote every 3 years. The next one is in June 2027. And I would say that although the performance in the first year of us running the trust has been poor, we need to put a wider perspective on things. And Will and I have been here before. In the 2020 COVID hit year, our open-ended unit trust was similarly facing challenging performance, but we stuck to our knitting. We didn't change the process, and the fund went on to perform extremely well in the following 4 consecutive years.
So do you think your analysis that led you into this underperformance was correct and the victim of external factors, or was it the case that you got some of that stock picking wrong that would justify you changing the portfolio to try and perform better from here? In other words, is it fair to characterize it as saying that you are sticking with your existing portfolio positioning?
Absolutely. We've made our investment decisions based on our usual 3 to 5 year time period.
Okay, so I'm sure the board will be very familiar with those dynamics, but on the face of it, you are going to have to put in quite a good performance over the next 12 months to justify their confidence. The other point is your market cap's around 100 million, I think. Would you say that's okay for a UK small cap trust? You'd obviously like it to be bigger, but is it actually too small for the current environment?
I would say that the size of the trust is towards the bottom end of the range of what you would want. Obviously, when a trust gets too small, the fixed costs push the ongoing charge up. We're not at that stage at the moment, but it does allow us to be nimble in terms of investing. So at the moment, there is no issue with the size of the trust.
You say you're a long-term investor and you're sticking with your basic portfolio. What impact does the current drama, I suppose you have to call it, that's going on in Westminster have on that? I mean, it creates more uncertainty and that's not good for looking for new investors for the trust. Are you worried about what the new government, which looks like being run by Andy Burnham, is going to do? You referred obliquely at least to what Chancellor Rachel Reeves did in her first budget, which wasn't particularly helpful. Are you worried or excited about what this new regime might do, which is different?
My observation there would be that investors, to our way of thinking, worry far too much about politics generally in investments. I would say that the Labour government was elected with many plans for growth, which we haven't really seen in terms of new policies. So the expectations from investors in the UK is very, very low. There's nothing priced in for new growth policies. If the new Prime Minister can deliver some growth initiatives, that would be upside potential to investors' current thinking, but there's nothing priced in. So there's an opportunity there to change.
I mean, some would say that a big increase in defence spending, if it were to happen, would have a stimulative effect. But are there many companies that you would consider investing in who might benefit from that? Or are you actually prohibited from investing in defence companies on other grounds?
Well, the stock market, I would say 2 or 3 years ago, had a big push on ESG factors. And in that push, defence companies were kind of pushed to the bottom of the pile. And so a few of them became quite cheap. So we invested in companies like Babcock, Kinetic, Chemring, and have generally done very well out of that push. So I suppose we're opportunistic in terms of, we're not trying to guess future policy and invest. We see what the value is and led by that. Is it worth talking about how we see our investment process being different to other small cap managers? Because I think the way Will and I run money is very different to most other small cap managers.
Well, presumably that is the case, just by inference. But yes, why don't you tell us briefly, if possible, what the differences are?
The biggest difference that we see is our valuation discipline. So in a sector where I think about 80% of small cap managers run funds whose companies are more growth oriented than the index, we are very valuation disciplined. If you look at a graph of value shares and growth shares in small cap land in history, value shares massively outperform growth shares. And yet most of the managers are much more growthy. So what you pay for a company determines your future return. So we would argue that we have a very strong valuation discipline. You can see the portfolio is on 9 times consensus forecast earnings for next year. And importantly for us, on a 10% free cash flow yield, which we think evidences that valuation discipline. So that's one big difference. The second difference is while most small cap managers, to our mind, look at profits, PE, EV, EBITDAs, profit related statistics, we focus on cash flow because it's cash that pays wages for staff. It's cash that pays dividends for capital projects to expand. Profits can be easily manipulated, whereas cash much less so. So Will and I tend to talk in terms of free cash flow relative to the market valuation of companies and think about that. So that's another difference. As I said, the free cash flow yield on the fund is 10%. And that is after paying tax, insurance, capex, any exceptional redundancy costs, pension top-ups, occupied leases, that kind of thing. So it's a kind of hair-shirted number. And then the third thing is that we don't seek out catalysts to invest. So we deliberately take a long-term view. And by doing so, we open up a vastly wider range of companies that we could invest in. And you can see from our portfolio turnover of the open-ended unit trust, it's averaged a 6-year holding period over the last 10, 15 years. We generally do what we say in being long-term investors.
Let's then talk just a little bit about gearing, very briefly. Gearing is meant to be one of the great structural advantages of running an investment trust. I'm not quite sure how you're using gearing. I don't think you are using much at the moment. If you're so confident in your ability to outperform from here, would you not be persuading the board to add a bit more gearing?
Absolutely, yes. And we have. To be fair, Invesco were using gearing through debt before we took over the fund. We have suggested adding between 0 and 10% gearing to the fund. We're currently sitting at about 8% gearing. We've done that via contracts for differences because that was a much cheaper way of gearing the portfolio relative to bank debt. And we're towards the top of the range currently because of the value that we see in the portfolio at the moment. And so our thinking is that we're likely to stay at that level. It won't change much. And it's just, we don't want to put too much debt in, too much gearing because of the problems of if the market were to fall substantially. But in view of the very good value that we see at the moment, we're towards the high end of the range.
Now, the reason I mentioned that was because on the AIC website, in the statistics there, they're showing you as having 0% gearing, which maybe they haven't picked up on the fact that you're using CFDs to do that. That might be something worth looking at. The other question I was going to bring up was that very topical issue of AI. How, if at all, does that impact on you and the portfolio of your trust? Are there opportunities to benefit from it? Are you using it yourself? Is it distorting the valuations of the kind of stocks that you're investing in?
There's a lot there to answer. So yes, yes, and yes. I've already talked about the challenging year of performance. The market's view that many of our companies are threatened by AI has been one of the performance drags. I mean, this is a very fast-moving, evolving subject. So all of the companies in that kind of AI threat bucket, we've met again and talked about how the management teams see those threats. And generally, those companies that we own have proprietary data that we feel is relatively well insulated from the threat of agentic AI. If your listeners would like, Will, my co-manager, has done interviews with the chief executives of both Money, which owns Money Supermarket, GB Group, and YouGov, and they're available on our website to have a look at. And we've kind of tested the proprietary nature of those businesses, and we think the market is taking a far too negative view, and therefore there's great value in those shares because the valuation of those companies has been hit by a risk that we think the market is overdoing. So to your second point, yes, virtually every company we speak to is using AI to some degree, mostly to make their processes more efficient, speedy, and to improve. I think we also need to be cognizant of the cost of using AI and whether that cost will increase in the future. So that's something to bear in mind when we're talking to companies. And the third point, do we use AI? Yes, we do, both from a corporate point of view and individually as fund managers at Artemis. And if we can use AI to search that collective knowledge, that helps us get to the answer quicker, faster, more efficiently.
And I guess one of the issues there is a lot of survey opinion seems to suggest that a number of companies are finding that it's helpful. But the question is it actually worth paying a lot of money for it? Is it actually worth the amount of money that the firm is spending on it?
I think that's yet to be tested, if I'm honest. I think there are lots of companies which are putting a lot of effort behind AI without really being able yet to demonstrate the return on that investment. And I think that will be the next stage in this fast-moving process of show me the benefits of that spending, especially as the costs of AI tokens rises. I think that will be something that will be interesting to see.
Just going back to the point about who's affected, I guess one would have to say those managers, they would say that, wouldn't they? I mean, that's what they're bound to say, essentially, that the impact is going to be less than the market's assuming. And that may be right in the short term, but question, is it right over the longer term? New technologies do tend to have lasting impact. Do you have any hope that there will be an AI industry in the UK that will become investable? Either AI itself or the picks and shovels in data centers or anything like that, or electricity generators. Do you think there are opportunities there to try and profit from this boom in AI if it does indeed continue at the pace it's going at the moment?
There may well be. The way Will and I run money, we don't go looking for potential boom areas. I suppose if we bear it back to the fundamentals, we see the valuation of a company as the future cash flows of that company discounted to today's value. And we're trying to pick up businesses where the valuation is at a discount to our expectation of those future cash flows. And my experience would be that when you've got an AI boom or any kind of boom or sexy growth story, normally the valuation is inflated with the expectation hoisted upon it by those thematic seeking investors. So that's generally an area where we don't play because the valuation is too punchy. And that goes back to my original point about the valuation discipline being important. When you're paying double, treble the average valuation for a thematic, whether it be AI or whatever the current boom is, that means the expectations on that company are very, very high. And frequently I've found in my 40-year career that it's very hard for the poor old company to live up to those high expectations. And that leads to share price disappointment. Having a very strict valuation discipline protects us and our investors from that risk.
Yes, that is definitely true, historically, I would say. But it's also true, of course, that, as we know, markets can stay irrational longer than companies can stay solvent. We saw that dilemma very much during the internet bubble. If you had a value style approach there, you were being carried out all the time as a fund manager. And if you managed to stick to it, then you did do very well after that.
I would absolutely agree with you, Jonathan. So I was at Perpetual during that bubble, and my portfolio underperformed terribly in the kind of bubble year. We had 2 years of really poor relative performance. I remember my portfolio only rose 57% in that year when it had to have risen 100% to be competitive. But this is where I go back to, it's a long-term game. The following 3 years, we massively outperformed the competitors as they generally fell back when the bubble burst. So to me, that's why we are very strict with that, having a 3 to 5 year time horizon on our investments. That's absolutely key to us. This is a long-term game.
So what I think is interesting about this is that what you're telling me, if I interpret it correctly, is you're not going to change what you do. You're going to stick to what you do. And you're going to hope that these other factors that have dragged down your performance prove to be temporary. I think that's very praiseworthy because there's a time and a place for every style of investment. We have seen a lot of value investors struggling, and you are running up against the clock of the continuation vote. But I guess you'll have to make an argument to the shareholders that in the long run, you're going to prosper. That would be it, wouldn't it?
In a nutshell, absolutely. So we are not going to let any continuation vote change the way we invest. We invest in a very set way, and that won't change. If the performance hasn't picked up by then, we'll make the best presentation that we can to investors, and it's up to them to decide. Will and I would say, are extremely optimistic about the future because the valuation is just so low at the moment. If I can just repeat those statistics, that the PE of our portfolio is on 9 times next year's earnings, a 10% free cash flow yield. The average return on capital of our companies is 20%. On average, they have no debt, no net debt at all, and yet the earnings are growing at double-digit rate. If that was a company, we would say that's 50% mispriced. That's the degree of the mispricing in the market currently. The downside is what we can't do is say when that mispricing is going to right itself, and we make the supposition that somewhere within our 3 to 5 year time horizon, it would likely to be rectified. So that's our investment pitch, if you like. The way I kind of solidify that to myself is that in the last 6 years, we've had 37 takeovers in our open-ended unit trust at an average takeover premium of 48%. So pretty much bang on with our perception of that 50% misvaluation. And 2/3 of those companies are competitors taking out a competitor, and 1/3 of venture capitalists doing the financial arbitrage. And then the other thing which I think is important is the level of share buybacks that small caps are doing at the moment. I've been doing this job for 40 years. I've never seen before the level of share buybacks that we're currently seeing in small caps. This is a thing that large cap companies do, not small caps, and it's never been higher. And to me, that says three things. It says, firstly, the companies that we invest in have the spare capital to buy their shares back. As I said, they have on average no debt at all. They think their shares are cheap, so they're putting that capital to work to buying cheap shares. But most importantly, given the kind of investor negativity around this area, I think it says that the companies that we invest in, the management teams, are willing to commit that permanent capital to buying their shares back rather than kind of saving. So reading the media, you would think that we're facing an impending recession, disaster, horrible economic situation, given the low valuation. Now, if the management teams of our companies thought that, surely they would husband their cash and save it for the rainy day that's coming, for the redundancy and restructuring costs that they would need to pay out on. But they're not doing that. They're spending that money. So to me, the management teams are confident in the future, and that's evident in the share buybacks that we're seeing that we've never seen before. So that gives me and my co-manager Will the confidence in the undervaluation of our portfolio. I suppose as an addendum to that, Will and I have between us invested about £3 million in buying shares in the investment trusts, because what we see is a portfolio with those statistics, and yet we can buy the shares in the investment trust at a 13, 14, 15% discount to that already cheap looking valuation. So we see that as tremendously attractive. So although we're disappointed with our performance in the first year of managing this trust, we're absolutely seeing this as a golden opportunity to make some money here because of that valuation anomaly that we see.
Well, you certainly laid out the case for believing that. And as you say, your own investment in the fact that the trust is trading on a discount of 13%, and the fact you've got gearing in there means that if things at least don't go badly wrong, as you've just said, but do reasonably well, in due course, that value should be rewarded. Well, I hope for your sake that's the case. So I have been talking to Mark Niznik, the co-fund manager of Artemis UK Leaders, ticker AFL, has a market cap around 100 million and is, I say, one of two Artemis managed trusts that are now back in the sector. You are listening to the Moneymakers podcast. To keep up with every single item of news from the investment trust sector and all the latest share price, NAV and discount movements, why not try a subscription to the Moneymakers Circle, our premium content newsletter? You'll find there our in-depth independent profiles of more than 200 investment trusts and more commentary. Go to money-makers.co for more details. Do please like, subscribe and share through whatever platform you're using. As well as the usual podcast channels, we can also be found on YouTube, TikTok, X, Blue Sky, and most recently on Substack. Visit the website for more details. Next on the podcast, as noted earlier, I had the opportunity to speak to Alexander Fitzalan Howard, the manager of JP Morgan European Growth and Income Trust, ticker JEGI. As luck would have it, we last spoke the day before Donald Trump's Liberation Day announcement about tariffs, when there was a lot of trepidation in the markets about what might actually follow from that. But once the initial shock had worn off, it turned out that the tariff announcements, at least, were not all that bad, or at least as bad as many initially feared. Since then, of course, we've had another issue with the Iran war and continuing uncertainty about political developments in many countries across Europe. It's turned out to be a very good year for the trust. It put in a strong performance last year, comfortably the best in its sector, helped in part by a significant and continued improvement in the discount. In our last conversation, Alexander, you noted that you weren't making any changes in anticipation of what might happen after the tariff announcement, simply because you weren't sure what the implications would be, and of course, nor, I think, was Donald Trump himself. In the event, that turned out to be the right thing to do. So, looking back now, How would you interpret the way that the last 15 months have gone?
I think the market was very quick to discount the imposition of tariffs, and there was a feeling that President Trump would back down a certain amount from it when he saw the impact that it was likely to have across the world, and in particular the bond markets and so on. So the market pretty quickly took the view that it wasn't going to be as bad as they first feared. I think in a sense, if one looks back over the year, the whole tariff thing has sort of been pushed aside by what has happened more recently in Iran and events there. And that has really dominated the news flow this calendar year.
Yeah, so we've had a second kind of Trump-induced crisis. Or
more than two goes. It was Greenland and Venezuela and all sorts of things.
A lot of things have happened, let's put it that way. It certainly have. I think of the two that had the biggest market impact. And also at the same time, just over a year ago, we were talking about some significant changes in the political environment in Europe. It was just after the announcement by the Germans that they were giving up their debt brake and launching a big fiscal stimulus program. And we had the incidence of Marine Le Pen being banned from standing in the next presidential election. So there's been a lot of political turmoil, and we've seen that in the UK, obviously, of course, as well. But in terms of the markets and in terms of the performance of companies you invest in, they've mostly kind of sailed through without too much trouble so far.
Yes, I think on the whole, that's been true. I mean, you mentioned the fiscal boost. And I think that is really starting now to bear fruition and come through in reality. There was a bit of criticism late last year that people were getting impatient with, where is it, what's happening? Now I think it has started to come through. We're starting to see defence orders materialise, although not always in the way that people have expected. And also on the fiscal side, money flowing into infrastructure. I think defence is interesting because that's what springs to people's minds first of all. And it's interesting that the sort of bellwether for defence in Europe is Rheinmetall, the big German company. It's actually performed quite badly over the last year. And I think that's partly reflects how well it had done before. So the valuation had expanded. And then also a sort of feeling, I think, that the whole realm of defence has changed a bit. And Rheinmetall, for example, makes the Leopard tank. But I think as we've seen in Ukraine, warfare and defence has changed a lot. And, these very expensive tanks, for example, are now very vulnerable to very cheap drones. So there's a change in the mix, which I think is interesting. And on infrastructure, there's a ton of money flowing into renewing the electric grid, for example, the transition towards green energy and all sorts of things. So lots of opportunities there that we're seeing.
And how have you been able to take advantage of those? Has it resulted in significant shifts in your portfolio? Obviously, your target is you aim to outperform by 1 or 2% a year. You're taking a lot of beta, a lot of market risk. What kind of change in your portfolio have you been making? And are they directly in response to this kind of stimulus activity, or is it less direct than that?
Not huge changes, to be honest. We don't turn over the portfolio very much. But the fiscal boost is clearly a theme running through much of the portfolio. We have a little bit of exposure to defence. For example, we own Thales, a French company that makes a lot of the sort of technology behind defence, so sort of sensors and things like that, guidance systems for missiles. We don't own Rheinmetall, as mentioned before. On the more infrastructure side, companies like ABB, so they're crucial really at providing kind of the backbone, the interconnections. When a new factory or an AI data center is created, it needs a lot of electricity, and ABB are sort of crucial part of that build out.
Well, you mentioned AI. We might as well quickly cover that one as well. Everybody's been obviously talking about it, as we know, and some of the hyperscalers in the US have obviously been dominating the market for quite a long time, but some of the shine seems to be coming off that a little bit at the margin. Europe is not generally held to be a pioneer in AI, shall we say, lagging quite a lot, I think, in that area. But of course, there's money to be made by all the people who are providing the picks and shovels and doing all the stuff that goes into making the AI front edge. So is that been a theme at all? How have you been looking at that theme and how have you been taking advantage of it?
Absolutely. You're right about the hyperscalers, but they're obviously generating this huge sort of capex boom. And we have tried to take advantage of that. At one end of the spectrum, huge companies like ASML, which makes these very advanced chips. And really, ASML is the only company that can do that. They produce these massively expensive machines. absolute cutting edge technology. And if you want the leading chip, it will come through an ASML machine. So that's sort of one end of the spectrum, but all the way further down the curve, there are things that we can do. And for example, we also own a French company called Legrand that used to make low voltage plugs and things that you'd see around. But now they do like cooling systems and the racks and sort of interconnections within new AI data centers. And it's another way of playing that whole boom in artificial intelligence, which is rolling out rapidly across the world.
And we've seen overall, looking at the European equity markets overall, we've seen them performing very well, as I mentioned, perhaps exceeding expectations in some cases and outperforming the US for a large part of the last financial year you've reported on to the end of March. And more significantly, perhaps, we've seen quite a lot of flows into the European equities by investors. And that's new, right? Because Europe's recently been regarded as behind the curve in a lot of things, bureaucratic, political problems, Ukraine, all the negatives that we've grown used to, not a technological pioneer. So what do you think has been driving that? Is that more a reaction against the US sort of diversifying away from Trump effects, if you like, or is it actually people finding new things to like about Europe?
I think it's a mixture. We mentioned the fiscal boost already, which I think is an important backdrop, but you could also throw into the pot. The consumer is in pretty good shape. Savings rates are still very high. So the consumer has a lot of firepower. He just needs to feel a bit more confident to spend it. But there are opportunities there. Energy prices have been coming down post the Iran conflict, hopefully being resolved. But one way or another, energy prices are coming down and Europe is exposed to energy prices. So that is a good tailwind. And I think there's a feeling post the JEGI report that there's a lot of ways that European companies can improve their competitiveness. And so some of these sort of headwinds that people have been speaking about for years may just possibly become tailwinds. And then, of course, obviously the big contrast between Europe and particularly the US is the valuation. Because as you mentioned earlier, Europe has been out in the wilderness for quite a long time. And there's a big valuation gap, which even if it could be closed just a little bit, would be a good tailwind for European equities as well.
Not quite as big a gap as the UK market, but a gap nonetheless. Can you put some kind of numbers around that to give us an indication of the kind of PE ratio on the market that you're seeing and the other indicators that you look at?
Just at a sort of headline level, European markets at the moment on about 14 or 15 times. And the US obviously at a much bigger premium than that. And you can see that differential across pretty much all sectors. So whether you're looking at, I don't know, for example, financial companies or pharmaceutical companies or whatever, there are opportunities in Europe where you can buy fairly equivalent companies at a really quite a significant discount.
Do you think that's going to persist?
Well, I'm rather hoping that the discount might close a bit.
Yeah. What could drive that, though? I mean, we don't see interest rates coming down anytime soon, particularly, or do you? Are you hopeful of that?
No, I think they probably won't go up necessarily as much as people fear. I think as earnings come through, hopefully a surprise on the upside, that will attract more money into European equities and hopefully that will shut down some of the discount.
Right. So I guess what I'm driving at is, do you think we're at a kind of cyclical turning point? In other words, we've seen these flows come in the last 12, 18 months or so. Do you think this really could be the start of a particularly strong period for Europe?
We hope so, but it's fair to say that we've been here before when there have been sort of glimmers of light and it hasn't always sort of materialized. But there are clearly very positive signs around across European equities.
And just on the backdrop to that, of course, we also got what historically have been considerable concerns around the debt position of certain governments in Europe, not just in the UK, but across France, Germany, Italy, and so on. That's always there in the background, been there for a long time now. Is that a concern to you?
I think it's a long-term concern, yes. I mean, the way these deficits continue to rise can't go on forever. I'm not sure what would bring that to a crisis moment in Europe. Bond yields have gone up a bit, but not to the extent that it's sort of flagging a major problem.
So if we look at the style of what you do, I mean, you have, I think you describe it as a sort of quality value momentum approach, and you look for a number of things. Obviously, it's a bottom-up approach ultimately, keeping your market exposure fairly neutral. Of those three factors, what's been the one that's had the biggest impact on the kind of things that you're seeing appreciate in value?
I think over the last year, momentum has clearly been the big story. And by that, we're really talking about operational momentum. And for us, that means we look very closely at where companies are seeing analysts' earnings revisions moving. So if a company is having its estimates revised up, that's a very positive signal for us. Basically, the market thinks that things are getting better. And the same in reverse. If estimate revisions are coming down, then things are not as rosy as the market had hoped. And that's a warning signal.
Are you seeing that across the whole market, or is it just the stocks that you're picking up? Are there sectors where it's particularly notable?
I think it's been most notable over the last year, probably in the banking sector. This year, probably more in semiconductors and so on, where obviously there's been a big boom. Yeah. And sort of on the downside, bad areas have been auto OEMs, which seems to get worse and worse. And that competition from China and so on.
And there have been big news announcements from the German automakers, for example, about laying off lots of people.
Very difficult area.
Yeah.
So momentum really crucial. I think what we're a little bit different from other investors in the market is that we have that sort of three-pronged approach. So momentum and quality, a lot of people do, but I think there's not many people in the European space who also have a sort of value component. And it's trying to combine all three, which we hope gives us this more sort of persistent and sustainable performance.
So if we look at the performance over the last year or so, as I say, you've performed very well. I think you're up around 21% or something in the last results, and you've outperformed most of your peers. How much of that is due to the discount narrowing and how much is actually fundamental performance?
Well, the thing that we as managers really focus on is that NAV performance, because the share price is somewhat beyond our control. Mm-hmm. The board are obviously very concerned about the discount and they manage that sort of process. So we're really focused on the NAV bit. And that has certainly been a key bit of the outperformance.
Because I think the others have not necessarily seen their discounts move quite as much as yours has. As you say, it's the board's responsibility, if you like. But for a long time, you've traded discount more than 10%. I mean,
yes,
double
absolutely.
digit. The board obviously now has a target of keeping it in single digits, as I understand it. And you've recently been trading around par, which is obviously very good news. Yeah.
Big change.
So why are people flocking to you rather than necessarily to one or two of the others?
I mean, I think to be fair, I think the whole sector has come in a certain amount. And then at the moment, we've had good performance. And I think money does tend to follow that a bit.
Right. I mean, I noticed in one of the research notes that was put out about it, it sort of made the point, well, you can't go on outperforming at this rate. In other words, what I was trying to drive at was how much of this you think has been a sort of one-off year where your particular style has worked well. You've been doing this for 20 years now, so there'll be periods when your style does well and periods when it doesn't. How confident are you that this might persist, shall we say?
Well, obviously we hope it will persist, but it would be most unusual to get 20 years in a row of outperformance. But the way we manage it is to try and create this sort of incremental, steady performance. Part of that comes from being overweight those three characteristics that you mentioned before, value, quality, and momentum. But also we construct the portfolio in quite a sort of risk-constrained and careful way. So we're not taking big country bets or big sector bets. And the idea of all that is to try and create a sort of core, diversified, balanced portfolio that should be able to outperform in different market conditions. Where we struggle is if the market becomes really sort of growthy and investors pay almost anything to buy the fast-growing companies. In that sort of environment, we will lag the market.
And we talked last year about the inherent advantages of the investment trust structure. And it might be worth just revisiting that because obviously a lot of people have been more focused on the relative performance of investment trusts over the last 3 or 4 years when the discounts have widened significantly. But that's now reversing and hopefully we'll not go back to that state of affairs. And when we spoke a year ago, you talked about the 3 main advantages that the investment trust structure gives you, which is sort of managing flows, as I believe it, in the gearing and the enhanced dividend that you pay, using reserves where possible. That's worked out well as a good formula. And are you seeing now the benefits of the investment trust structure in the last financial period? Or is it just your fundamental underlying performance? What's feeding that?
I think in terms of the performance, a little bit has come from gearing because we've been in an up market, but the gearing is pretty modest. I mean, we're normally in this sort of 5 to 8% range, so it's not going to really drive anything. But at the same time, the market's come off a bit, it's not going to kill us. So gearing has certainly contributed. I think in terms of the advantages of the investment trust, we get told again and again by the shareholders that they like this kind of smoothing of the income and paying the 4%, which is announced at the beginning of the financial year, and it comes quarterly, and there's a sort of regular stream of income that people like. But the key point to make from our side is that that doesn't drive how we invest the portfolio. So we're investing on a total return basis. And if the portfolio doesn't generate enough income naturally, which at the moment it doesn't, the portfolio currently yields 3 and a bit, and the dividend is set at 4, then the board, the company, trust can pay the balance out of reserves, as you mentioned.
Yeah, and that was a change that was introduced about a couple of years ago now.
In 22.
22, so a few years ago, yeah. And that does seem to be popular. One consequence, perhaps, of your recent performance has been that you recently announced that the board has agreed a potential transaction with another European trust, European Opportunities Trust, which has had its struggles over the year and got involved with Saba Capital, had a run-in with them, as a result of which you may be able to bulk up your trust a little bit. When we spoke a year ago, you talked about whether your then market capitalization around 470 million was big enough for the kind of current environment investment trust where wealth managers like big vehicles. You're currently at 625 million, thanks to performance.
Yeah, thereabouts.
So European Opportunities Trust has about, I think, 420 million, something like that, current market cap. You're not going to get all of that. But what difference is that transaction, when it goes through, going to make to the trust? You don't have capacity problems.
No, there's no issue about sort of liquidity or any of that. I think, as I see it, there are really two main things. If we can take on board some of their assets, it obviously makes our trust bigger. And for the big wealth managers, as you say, that's increasingly important. So if that opens up a bit of a new market for us, that should help keep the discount nice and tight. It's the one thing. And the other thing is that our fee structure is scaled. So as the trust grows, the average fee on the whole trust will come down a bit. And obviously that is a good thing for shareholders.
Indeed. But it won't change anything that you do, but it's helpful for the
It
shareholders.
would be great. And obviously we welcome as many EOT shareholders as want to come and join us.
We talked about the trend towards consolidation last year. Do you think that in your sector there's room for any more consolidation? Well, it has come down quite a lot.
And there's shrinking.
The numbers are shrinking and will shrink further when this deal goes through. So you'll be down to, I think, 4 or something in the main European sector. They're all quite reasonable.
They're all reasonable size. Some have done better than others. I think it's really important that there are at least 2
keep you honest,
strong funds in the sector. Let's see what happens.
One other thing about the portfolio, you obviously have the capacity to go down the market capitalization scale. And last year, I think you had about 10%, something like that, in smaller companies. I noticed that your holding in JP Morgan European Discovery Trust has popped up in the top 10. Does this signify that you've been increasing your holdings of small and mid-cap companies, or is that just some other factor?
Overall, we have marginally increased our exposure to small cap companies, but it's pretty modest. We haven't changed our shareholding in European Discovery Trust, but it has performed quite well.
It's got more valuable.
Yes, exactly. But there's been no big change. I mean, I think there are a lot of attractive opportunities in small cap, but the whole area has kind of struggled at the moment to get its time in the limelight, I would say.
What would be the kind of upper range of what you could ever envisage having, or what have you ever had in small and mid cap?
I think if you look back in the past, the top end has been about 20%. We tend to look at it as sort of non-benchmark. So still continental European companies, but not actually in the index that we're benchmarked against. And historically, roughly 20% has been the top end, and we're currently at about 13.
Finally, if I can come back to, as I said earlier, you've been managing this particular trust for 20 years, a bit more, I think, which means you must have started just before the global financial crisis involved.
Yes, indeed.
So you lived through that and lived through COVID and the Ukraine war and inflation and so on. What do you think the outlook for Europe is, taking that as a longer perspective? We've had a lot of political turmoil, as I mentioned at the beginning, a lot of issues around productivity in Europe. You mentioned the Draghi report.
Yes.
And now, obviously, the challenge of defence spending, which you've mentioned as well, and the issue, it hasn't gone away, of reliance on imported energy at the margin. All of those are still there. But is Europe in a better place now, do you think, than it was when you started?
Oh, for sure. Yes, absolutely. I think undoubtedly. I mean, if we look at the financial system, it's much better capitalized, much more secure, and obviously that can finance growth. I think Europe has kind of started to realise that it needs to address some of the issues, and defence is one. But the Draghi report does highlight a lot of things that would make a big difference. And I think if they can get to grips with that, there's a lot of light at the end of the tunnel. It's a big domestic market by just virtue of having 400 million people or whatever. There's a lot to play for, I would say. And there are signs that things are starting to fall into place, but it will take time. But within that, for us as stock pickers, there are lots of opportunities that we can try and extract from that.
Well, your job is obviously to find the best performing companies and invest in them. I mean, I guess the other shadow that some people might say hangs over Europe, but I talked about political disruption. Obviously, people are concerned about the rise of populist parties in some of the largest economies in Europe, in France and in Germany. Do you have any anxieties about that? I mean, it's not a factor you can control, but is it something that you've seen seeping into the way that Europe operates? Is that something that could, if you like, prove an impediment to the progress that you've talked about over the last 20 years?
I don't think it has so far. I think things need to get very extreme to make a really significant difference. And again, we sort of touched on it earlier, but there have been many crises over the last 5, 10, 15 years that corporate Europe has navigated its way through, and we hope that that will remain the case.
And then in terms of concentration, I mean, people talked a while ago about how there was some degree of concentration in the European market in terms of luxury goods and so on, but it's not really a factor. So it remains a much more diverse than many others.
Certainly the shape of the market, going back to your earlier question, has changed a lot over time too. I mean, if we go back 20 years, big energy companies, big utilities, and slightly moribund sort of banks dominated the market. And now that's really changed a lot.
So overall, the message you're giving me is a fairly positive one about Europe.
That's the hope. Yes, absolutely.
And looking back at the 20 years, you're not just saying that because, equity managers are always optimistic. We know that.
No, there are strong reasons to be optimistic for Europe.
Very good. Well, let's hope that they're realised. So that was Alexander Fitzalan Howard, the manager of the JP Morgan European Growth and Income Trust, ticker JEGI.
Thank you for listening to the Moneymakers Investment Trust podcast, sponsored by JP Morgan Asset Management and independently produced and edited by Moneymakers. If you like what you have heard, do tell your friends and colleagues, and remember to subscribe through your favourite podcast app or at the website so you never miss an episode. And follow us on our social media channels. For more news, commentary and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription. All details are at the website money-makers.co. Podcasts are provided for educational purposes only, and nothing you have heard from any speaker should be regarded as constituting investment advice.